or Rajat Jain, Chief Investment Officer at Principal PNB Asset Management, joins us on the show. Good having you, Mr. Jain. Thanks for joining in.
My pleasure.
What would you be doing? We studied the data at the end of Jan. Fund houses across the country, maybe there are a few exceptions, but we're sitting on close to about 35,000 crores of cash. Now, with the presumption that you too would be having some bit of cash in your portfolio, are these falls giving you an opportunity to invest, or do you believe that fundamentally there could be levels lower which will give you a better opportunity to invest the money?
Well, thanks, Neeraj. As a fund house, your first part of your question, we don't really keep large amounts of cash in our portfolio. So cash in our fund would be 3 to 4% of our portfolio overall. So not a large amount of cash that we have. And to the second part, is it a good time? We would actually go with, we still think that India is reasonably valued. There was a bit of froth in the markets, particularly in the mid-caps, select mid-caps, which seems to have gotten corrected. So yes, if I was looking for investing equity 2 to 3 years out, I would be very clearly a buyer in the market at this point of time.
But you're not worried about the possibilities of levels correcting further? Not really necessarily because of what's happening in India alone, but primarily because of what's happening across the globe. I think the ECB yesterday was very, very hawkish. BOJ day before yesterday, fairly hawkish. Those statements aren't exactly great for yields and maybe thereby for fund flows.
Yes, but who can call the market? It's more about, you can do a bit of timing in the market, but I think most people get it right. At least we can't get it right consistently over long periods of time. And as I said, we don't have large amounts of cash in our portfolio, and where we do find stocks have corrected, we are looking to, add them to our portfolios. Certainly we are not sellers in a big way in the market at these levels. Also, what we have seen is, as the markets have corrected, fund flows into the funds have remained reasonably robust. We're not seeing large amount of redemptions from retail investors. So overall, I think it's still a stable market, for equity investors.
Hi, Mr. Jain. Good morning. This is Navneet. In fact, I was coming to that question of redemption. Is there any selling pressure which is coming from the retail investors? Because last year, 2017, we did see huge amount of inflow from that class coming into the mutual funds.
Yeah, no, not at all, actually, not at all. We are seeing, certainly you have some redemptions clearly, but on the net basis, it still inflows into the funds.
Okay, and you've been pretty bullish on the domestic recovery theme. So does this correction give you any sort of opportunity to look at sector rotation? If yes, if you could just talk about those sectors.
Yeah, as I said and on your channel itself earlier, we have been, bullish on the domestic cyclicals. So it's like auto ancillaries, we have cement, financial, though we underweight a very large benchmark. So we underweight the benchmark, but a large exposure in our portfolio. So I think, we are not changing that strategy wholesale, except, as I said earlier, if the stocks have corrected, substantially in this recent fall, and then become much more attractive, we may look to add to those in our portfolio.
Mr. Jain, I understand the net flows would be positive, but just wondering, 2 or 3 AMC houses that we spoke to ahead of the budget mentioned the same thing, that while the net is positive, but there is some bit of outflow that has happened on the mutual fund space. My question to you is, have you witnessed similar behavior post this market fall? Sure, the net flow could be positive because the SIP money might be staying put, but are people redeeming in a much higher quantum than what they were in the preceding 6 months?
I can speak for my fund house. We have not seen that kind of a behavior. Even outside of SIPs remain absolutely, but even outside of including, say, lump sum and those kind of investments, we are seeing, no difference in behavior. We will always have people redeeming, people who came in probably 2, 3, 4 years ago and they're seeing long-term gains. They want to take some money, which is absolutely perfectly fine. But is there a big difference is there a big shift in behavior? Are people redeeming much more? No, we're not seeing that yet.
Okay. Touchwood. The other bit, Mr. Jain, is because you would have seen these cycles a number of times. Based on I mean, the kind of correlation that people are talking about, and I know it's difficult to time or difficult to really call a particular level, but just looking at the commentary that is coming in from central banks across the world, the RBI as well, and you would have heard that day before yesterday too, do you believe there could be a percentage fall that we could see before the market starts stabilizing, or even that is difficult to call currently?
That's difficult to call, but yes, it's possible. See, I mean, from the highs, when you see the markets, if you look at last year, calendar 17, I mean, we know how the markets did. Mid cap about 35 odd percent, the small caps 50, 55, 60%. The Nifty is just close to 30 odd percent. And so great returns. And it's possible that the markets fall 5, 7, 8%. I mean, that is, so two things. A, I think there is money on the sidelines. Markets are not crazily expensive. But what does happen, I think I totally get your point about rising rates. It does, I mean, lead to certainly like P compression, as it were. I mean, certainly we don't see P expanding at these levels. While earnings are coming in, we don't see P expansion at these levels. So we are ourselves, I mean, we are looking for moderate gains in calendar 2018. And the second thing that we're also saying is, I think in the last quarter of 2017 and last half of 2017 as well, I think people were just putting money into equity, ignoring asset allocation, ignoring debt. So now debt has become a good asset class. I mean, the portfolio yields have gone up substantially. For example, if you look at a short-term plan of, say, our fund house or any fund house generally, I mean, the yields would be upwards of 8%, 8.15, 8.20 there, the gross portfolio yield. So reasonably attractive. They are not very long maturity funds. They're probably 3-year maturity on the outside. So these are good places to be as well. So I think what we will see is equity will remain good, but also people will look at fixed income as well, which is a good thing to have a balanced asset allocation.